In recent years, inflation has become a topic of intense discussion and debate, particularly in the context of the US Federal Reserve's monetary policy. As the world grapples with economic uncertainties, the Fed's role in managing inflation has come under scrutiny. This video will dive deep into the complexities of the Fed's inflation dilemma, exploring the history, the mechanisms at play, the challenges faced, and the potential implications for the future. We'll expose the intricacies of this issue with new information, a different perspective, and a fact-based analysis supported by data. To understand the Fed's current inflation dilemma, we must first explore its origins. The Federal Reserve was established in 1913 with the primary goal of ensuring financial stability. However, over the years, its mandate expanded to include managing inflation and maximizing employment. The dual mandate, price stability and maximum employment, was officially established in the 1970s. However, the seeds of the inflation dilemma were sown much earlier. During the 1960s, the US government pursued an ambitious fiscal policy, including the Vietnam War and the Great Society programs, which led to increased government spending. At the same time, the Fed maintained an accommodative monetary policy, resulting in high inflation during the 1970s, known as the Great Inflation. The lessons learned during this period led to a shift in the Fed's approach, emphasizing the importance of controlling inflation. However, the balance between managing inflation and supporting economic growth has always been delicate. This historical context sets the stage for understanding the current challenges. Before delving into the current inflation dilemma, it's crucial to understand the mechanics of inflation and the tools the Fed uses to manage it. What is inflation? Inflation refers to the general increase in prices of goods and services over time, which erodes the purchasing power of money. There are two primary types of inflation: demand pull and cost push. Demand pull inflation occurs when demand for goods and services exceeds supply, driving prices up. Cost push inflation happens when production costs rise, leading to higher prices for consumers. The Fed's challenge lies in managing these types of inflation while balancing economic growth. The Fed has several tools at its disposal to manage inflation. Interest rates. The Fed can raise or lower interest rates to influence borrowing and spending. Higher interest rates tend to reduce demand, helping to control inflation, while lower rates can stimulate the economy. Open market operations, OMO. The Fed buys or sells government securities to influence the money supply. Buying securities injects money into the economy, potentially leading to inflation, while selling them withdraws money, reducing inflationary pressures. Reserve requirements. The Fed can change the reserve requirements for banks, affecting how much money they can lend. Higher reserve requirements reduce the money supply, which can help control inflation. Quantitative easing, QE. In times of economic crisis, the Fed may use QE, purchasing long-term securities to inject liquidity into the economy. This can stimulate growth but also carries the risk of inflation. These tools are not without limitations, and their effectiveness depends on various factors, including the broader economic environment. As of 2024, the US economy faces a unique set of challenges that have intensified the Fed's inflation dilemma. To understand the current situation, we need to examine the factors contributing to inflation, the Fed's response, and the implications of these actions. The COVID-19 pandemic had a profound impact on the global economy. In response to the economic downturn, the Fed implemented an unprecedented level of monetary stimulus, including near-zero interest rates and massive quantitative easing programs. These actions helped prevent a deeper recession but also laid the groundwork for inflationary pressures. The supply chain disruptions caused by the pandemic led to shortages of goods, driving up prices. At the same time, the surge in demand as the economy reopened further exacerbated inflationary pressures. By 2022, inflation in the US had reached levels not seen in decades, with the Consumer Price Index, CPI, rising by 7.0% year-over-year, the highest since 1982. What about the role of fiscal policy? In addition to the Fed's monetary policy, fiscal policy played a significant role in shaping the current inflation landscape. The US government implemented several stimulus packages, including direct payments to individuals, enhanced unemployment benefits, and business support programs. While these measures were necessary to support the economy during the pandemic, they also contributed to increased demand, putting upward pressure on prices. The combination of expansive monetary and fiscal policies created a perfect storm for inflation. The Fed now faces the challenge of unwinding these policies without derailing the economic recovery. Global supply chain disruptions have been a significant driver of inflation in recent years. The pandemic exposed vulnerabilities in global supply chains, leading to delays, shortages, and higher costs. For example, the semiconductor shortage has affected various industries, from automobiles to consumer electronics, leading to price increases. The Fed's ability to control inflation is limited when it comes to supply-side issues. While the Fed can influence demand through its monetary policy, it has little control over global supply chain disruptions. This adds another layer of complexity to the inflation dilemma. The Fed's response to the current inflationary pressures has been closely watched by economists, policymakers, and the public. The central bank's actions have far-reaching implications for the economy, financial markets, and households. One of the Fed's first steps in addressing inflation was to begin tapering its asset purchases. In November 2021, the Fed announced that it would start reducing the pace of its monthly bond purchases, a process known as tapering. This marked the beginning of a shift away from the ultra-accommodative monetary policy implemented during the pandemic. Tapering was seen as a signal that the Fed was preparing to raise interest rates to combat inflation. However, the Fed faced a delicate balancing act. Moving too quickly could disrupt financial markets and slow economic growth, while moving too slowly could allow inflation to spiral out of control. In 2022, the Fed began raising interest rates to curb inflation. By mid-2023, the federal funds rate had been raised several times, reaching 4.5%. The Fed's goal was to bring inflation back to its target rate of 2% while avoiding a recession. Interest rate hikes are a powerful tool for controlling inflation, as they increase the cost of borrowing and reduce consumer and business spending. However, they also carry the risk of slowing down economic growth and increasing unemployment. This is the essence of the Fed's dilemma: finding the right balance between controlling inflation and supporting economic activity. The Fed's actions have had a significant impact on financial markets. The prospect of higher interest rates led to increased volatility in stock markets, with some sectors, such as technology, particularly hard hit. Bond markets also experienced turbulence, as rising rates led to declining bond prices. The Fed's communication strategy became crucial in managing market expectations. Clear and consistent messaging helped to reduce uncertainty and avoid panic in the markets. However, the challenge remained: how to tighten monetary policy without triggering a market crash. Inflation expectations play a crucial role in shaping actual inflation. If businesses and consumers expect higher inflation in the future, they are more likely to raise prices and demand higher wages, creating a self-fulfilling prophecy. The Fed closely monitors inflation expectations through various surveys and market indicators. As of 2024, inflation expectations had started to moderate, suggesting that the Fed's actions were having the desired effect. However, the central bank remains vigilant, as unanchored inflation expectations could lead to persistent inflation. The Fed's inflation dilemma is not occurring in isolation, it is part of a broader global economic landscape. Understanding the international factors influencing inflation and the Fed's actions is crucial for a comprehensive analysis. The actions of other central banks, particularly in developed economies, influence the Fed's decision-making. For example, the European Central Bank, ECB, and the Bank of England, BOE, have also faced inflationary pressures and have begun tightening their monetary policies. The coordination, or lack thereof, among global central banks can have significant implications for the global economy. If central banks move in different directions, it could lead to capital flows, currency volatility, and imbalances in the global financial system. Global trade dynamics also play a role in shaping inflation. The US is deeply integrated into the global economy, and changes in trade policies, tariffs, and supply chains can affect domestic inflation. For example, the US-China trade war, which began in 2018, led to higher tariffs on imported goods, contributing to inflationary pressures. While the Biden administration has sought to ease some of these tensions, trade-related inflation risks remain. Energy prices have been a significant driver of inflation in recent years. The global energy crisis, exacerbated by geopolitical tensions and supply constraints, has led to higher oil, gas, and electricity prices. These increases have ripple effects throughout the economy, raising production costs and consumer prices. The Fed's ability to control energy-related inflation is limited, as it cannot influence global energy markets. This adds another layer of complexity to the inflation dilemma, as rising energy costs can have a cascading effect on the prices of goods and services across the economy. For instance, higher fuel prices increase transportation costs, which in turn can raise the cost of food and consumer goods. In 2022, the price of crude oil surged to over $100 per barrel, a level not seen since 2014, contributing significantly to inflationary pressures. The Fed's challenge is to manage the inflationary impact of energy prices without causing undue harm to economic growth. While raising interest rates can cool demand and thus reduce some inflationary pressures, it may not be effective in addressing supply-side issues like those seen in the energy sector. As a result, the Fed must carefully calibrate its policy responses to avoid exacerbating economic vulnerabilities. One of the Fed's greatest concerns is the risk of overcorrecting in its efforts to control inflation. If the Fed tightens monetary policy too aggressively, it could lead to a recession, increased unemployment, and financial instability. This section will explore the potential consequences of overcorrecting and the challenges the Fed faces in striking the right balance. When the Fed raises interest rates, borrowing costs for consumers and businesses increase. This can lead to a slowdown in spending, investment, and economic growth. If the Fed tightens too much, it could push the economy into a recession. During the early 1980s, for example, the Fed under Chairman Paul Volcker raised interest rates sharply to combat high inflation. While this successfully brought inflation under control, it also led to a severe recession, with the unemployment rate peaking at 10.8% in 1982. The Fed is acutely aware of the lessons from the Volcker era and is trying to avoid a repeat of that situation. However, the current economic environment is different, with unique challenges such as global supply chain disruptions and the lingering effects of the pandemic. This makes the task of avoiding a recession while controlling inflation particularly difficult. The Fed's dual mandate requires it to balance price stability with maximum employment. However, these goals can sometimes be in conflict. Tightening monetary policy to control inflation can lead to higher unemployment, as businesses cut back on hiring and investment in response to higher borrowing costs. The Fed must carefully consider the trade-offs between these objectives. As of 2024, the US unemployment rate remains low, but there are signs of softening in the labor market. Job growth has slowed, and some industries, particularly those sensitive to interest rates like construction and real estate, have begun to see layoffs. The Fed faces the difficult task of managing inflation without causing a significant rise in unemployment, a challenge that requires precise and timely policy adjustments. Financial markets are also highly sensitive to the Fed's actions and communications. Rapid changes in monetary policy can lead to increased volatility in stock and bond markets, as investors adjust their expectations for economic growth, corporate earnings, and interest rates. This volatility can create challenges for the Fed, as sharp declines in asset prices can erode consumer and business confidence, potentially leading to a self-reinforcing cycle of economic weakness. In 2022 and 2023, for example, the Fed's interest rate hikes led to significant declines in equity markets, with the S&P 500 experiencing a bear market and technology stocks particularly hard hit. Bond markets also faced challenges, as rising rates led to falling bond prices. The Fed must navigate these market dynamics carefully, as excessive volatility can have negative spillover effects on the broader economy. In this section, we'll explore some alternative perspectives on inflation and the Fed's role in managing it. These perspectives offer different ways of thinking about the inflation dilemma and provide valuable insights into potential solutions. Modern monetary theory, MMT, has gained attention in recent years as an alternative framework for understanding monetary policy and inflation. MMT proponents argue that a government that issues its own currency, like the United States, cannot run out of money and can finance large-scale spending programs without necessarily causing inflation. According to MMT, inflation only becomes a problem when the economy reaches full productive capacity, and the government should then use fiscal policy, e.g., raising taxes or cutting spending, to cool demand. From an MMT perspective, the Fed's focus on controlling inflation through interest rate hikes may be misplaced. Instead, MMT advocates suggest that fiscal policy should play a more prominent role in managing inflation, particularly in addressing supply-side issues such as infrastructure investment, healthcare, and education. Critics of MMT, however, argue that it underestimates the risks of inflation and the importance of maintaining central bank independence. Some economists argue that structural factors, such as demographics, technological advancements, and globalization, play a significant role in shaping inflationary trends. For example, the aging population in many developed countries could lead to lower inflation in the long term, as older individuals tend to spend less. Similarly, technological innovations that increase productivity and reduce production costs can help keep inflation in check. From this perspective, the Fed's inflation dilemma may be partly influenced by forces beyond its control. While monetary policy is important, it may need to be complemented by structural policies that address these longer-term trends. This could include policies that promote innovation, education, and workforce development to enhance productivity and support sustainable economic growth. Income inequality is another factor that can influence inflation and the effectiveness of monetary policy. In recent decades, income inequality has increased in many countries, including the United States. Some economists argue that high levels of inequality can suppress demand, as lower-income households have less disposable income to spend, while wealthier households tend to save more. This could create a situation where traditional monetary policy tools, such as interest rate cuts, are less effective in stimulating demand and controlling inflation. Addressing income inequality through targeted fiscal policies, such as progressive taxation and social welfare programs, could complement the Fed's efforts to manage inflation and promote more balanced economic growth. As we look to the future, the Fed's inflation dilemma is likely to persist, with new challenges and uncertainties emerging. In this section, we'll explore some of the potential scenarios and considerations for the Fed in the coming years. What is the potential for stagflation? One of the biggest risks facing the Fed is the potential for stagflation, a combination of stagnant economic growth and high inflation. Stagflation poses a particularly difficult challenge for central banks, as the traditional tools for combating inflation, e.g., raising interest rates, can further weaken economic growth, while tools for stimulating growth, e.g., cutting rates, can exacerbate inflation. The experience of the 1970s, when the US faced stagflation, serves as a cautionary tale for policymakers. While the likelihood of a return to 1970s-style stagflation remains uncertain, the Fed must remain vigilant in monitoring economic indicators and be prepared to act swiftly if signs of stagflation emerge. The rise of digital currencies, including central bank digital currencies, CBDCs, and cryptocurrencies, could also have implications for the Fed's inflation dilemma. CBDCs, in particular, could provide the Fed with new tools for managing the money supply and controlling inflation. For example, the Fed could use CBDCs to implement more targeted monetary policy interventions, such as direct transfers to households or businesses, which could help address inflationary pressures more effectively. However, the adoption of digital currencies also raises new challenges, including the potential for increased financial instability, privacy concerns, and the impact on the traditional banking system. The Fed will need to carefully consider these factors as it navigates the evolving landscape of digital finance. Climate change is another factor that could influence inflation in the future. As the frequency and severity of climate-related events increase, supply chain disruptions, food shortages, and energy price volatility could become more common, contributing to inflationary pressures. The transition to a low-carbon economy, while necessary to mitigate the long-term impacts of climate change, could also lead to higher costs in the short to medium term. The Fed will need to incorporate climate-related risks into its inflation forecasts and policy decisions. This may involve closer collaboration with other government agencies and international organizations to develop coordinated responses to the economic challenges posed by climate change. In conclusion, the Fed's inflation dilemma is a complex and multifaceted issue that requires careful consideration of a wide range of factors, from monetary policy and fiscal policy to global economic trends and structural challenges. As the Fed navigates this difficult terrain, it must balance the need to control inflation with the goals of supporting economic growth and maintaining financial stability. In this video, we've explored the origins of the Fed's inflation dilemma, the tools at its disposal, the current inflation landscape, and the alternative perspectives that could shape future policy decisions. We've also examined the potential risks and uncertainties that lie ahead, from stagflation and digital currencies to climate change and structural factors. Ultimately, the Fed's ability to manage inflation will depend on its ability to adapt to changing economic conditions, communicate effectively with the public and financial markets, and collaborate with other policymakers to address the broader challenges facing the global economy. The stakes are high, and the decisions made in the coming years will have profound implications for the future of the US economy and beyond.